Chapter 5. When to buy. The preceding chapters attempted to show that the heart of successful investing is knowing how to find the minority of stocks that in the years ahead will have spectacular growth in their per-share earnings. Therefore, is there any reason to divert time or mental effort from the main issue? Does not the matter of when to buy become of relatively minor importance? Once the investor is sure he has definitely found an outstanding stock, isn't any time at all a good time to buy it? The answer to this depends somewhat on the investor's objective. It also depends on his temperament. Let us take an example. With the ease of hindsight, it can be made the most extreme example in modern financial history. This would be the purchase of several superbly selected enterprises in the summer of 1929 or just before the greatest stock market crash of American history. In time, such a purchase would have turned out well. But 25 years later, it would provide a much smaller percentage gain than would have been the case if, having done the hardest part of the job in selecting his companies properly, an investor had made the small extra effort needed to understand a few simple principles about the timing of growth stocks. In other words, if the right stocks are bought and held long enough, they will always produce some profit. Usually, they will produce a handsome profit. However, to produce close to the maximum profit, the kind of spectacular profit defined earlier, some consideration must be given to timing. The conventional method of timing when to buy stocks is, I believe, just as silly as it appears on the surface to be sensible. This method is to marshal a vast mass of economic data. From these data, conclusions are reached as to the near and medium-term course of general business. More sophisticated investors will usually form opinions about the future course of money rates as well as business activity. Then, if their forecasts for all these matters indicate no major worsening of background conditions, the conclusion is that the desired stock may be bought. It sometimes appears that dark clouds are forming on the horizon. Then those who use this generally accepted method will postpone or cancel purchases they otherwise would make. My objection to this approach is not that it is unreasonable in theory. It is that in the current state of human knowledge about the economics which deal with forecasting future business trends, it is impossible to apply this method in practice. The chances of being right are not good enough to warrant such methods being used as a basis for risking the investment of savings. This may not always be the case. It might not even be the case 5 or 10 years from now. At present, able men are attempting to harness electronic computers to establish input-output series of sufficient intricacy that perhaps at some future date it may be possible to know with a fair degree of precision what the coming business trends will be. When, if ever, such developments occur, the art of common stock investment may have to be radically revised. Until they occur, however, I believe that the economics which deal with forecasting business trends may be considered to be about as far along as was the science of chemistry during the days of alchemy in the Middle Ages. In chemistry then, as in business forecasting now, basic principles were just beginning to emerge from a mysterious mass of mumbo-jumbo. However, chemistry had not reached a point where such principles could be safely used as a basis for choosing a course of action. Occasionally, as in 1929, the economy gets so out of line that speculative enthusiasm for the future runs to unprecedented proportions. Even in our present state of economic ignorance, it is possible to make a pretty accurate guess as to what will occur. However, I doubt if the years when it is safe to do this have averaged much more than 1 out of 10. They may be even rarer in the future. The typical investor is so used to having economic forecasts made for him that he may start by trusting too strongly the dependability of such forecasts. If so, I suggest that he look over a file of the back issues of the Commercial and Financial Chronicle for any year he may choose since the end of World War II. As a matter of fact, it might pay him to look over such a file even though he is aware of the fallibility of these forecasts. Regardless of the year he selects, he will find, among other material, a sizable number of articles in which leading economic and financial authorities give their views of the outlook for the period ahead. Since the editors of this journal appear to select their material so as to give the ablest available presentations of both optimistic and pessimistic opinions, it is not surprising that opposing forecasts will be found in any such series of back issues. What is surprising is the degree by which such experts disagree with each other. Even more surprising is how strong and convincing some of the arguments were bound to seem at the time they were written. This is particularly true of some of the forecasts that turned out to be most wrong. The amount of mental effort the financial community puts into this constant attempt to guess the economic future from a random and probably incomplete series of facts makes one wonder what might have been accomplished. if only a fraction of such mental effort had been applied to something with a better chance of proving useful. I have already compared economic forecasting with chemistry in the days of alchemy. Perhaps this preoccupation with trying to do something which apparently cannot yet be done properly permits another comparison with the Middle Ages. That was a period when most of the Western world lived in an environment of unnecessary want and human suffering. This was largely because the considerable mental ability of the period was devoted to fruitless results. Consider what might have been accomplished if half as much thought had been given to fighting hunger, disease, and greed as was devoted to debating such points as the number of angels that could balance on the head of a pin. Perhaps just part of the collective intelligence nowadays employed in the investment community's attempt to guess the future trend of the business cycle could produce spectacular results if it were harnessed to more productive purposes. If then conventional studies of the near-term economic prospect do not provide the right method of approach to the proper timing of buying, what does provide it? The answer lies in the very nature of growth stocks themselves. At the risk of being repetitious, let us review for a moment some of the basic characteristics of outstandingly desirable investments as discussed in the preceding chapter. These companies are usually working in one way or another on the very frontiers of scientific technology. They are developing various new products or processes from the laboratory through the pilot plant to the early stages of commercial production. All of this costs money in varying amounts. All of it is a drain on other profits of the business. Even in the early stage of commercial production, the extra sales expense involved in building sufficient volume for a new product to furnish the desired margin of profit is such that the out-of-pocket losses at this stage of development may be greater than they were during the pilot plant period. From the standpoint of the investor, there are two aspects of all this that have particular significance. One of these is the impossibility of depending on any sure timetable in the development cycle of a new product. The other is that even for the most brilliantly managed enterprises, a percentage of failures is part of the cost of doing business. In a sport such as baseball, even the most outstanding league champions will have dropped some percentage of their scheduled games. The point in the development of a new process that is perhaps worth the closest scrutiny from the standpoint of timing the buying of common stocks is that at which the first full-scale commercial plant is about to begin production. In a new plant for even established processes or products, there will probably be a shakedown period of 6 to 8 weeks that will prove rather expensive. It takes this long to get the equipment adjusted to the required operating efficiency and to weed out the inevitable bugs that seem to occur in breaking in modern intricate machinery. When the process is really revolutionary, this expensive shakedown period may extend far beyond the estimate of even the most pessimistic company engineer. Furthermore, when problems finally do get solved, the weary stockholder still cannot look forward to immediate profits. There are more months of still further drain, while even more of the company's profits from older lines are being plowed back into special sales and advertising efforts to get the new product accepted. It may be that the company making all this effort is having such growth in revenue from other and older products that the drain on profits is not noticed by the average stockholder. Frequently, however, just the opposite happens. As word first gets out about a spectacular new product in the laboratory of a well-run company, eager buyers bid up the price of that company's shares. When word comes of successful pilot plant operation, the shares go still higher. Few think of the old analogy that operating a pilot plant is like driving an automobile over a winding country road at 10 miles per hour. Running a commercial plant is like driving on that same road at 100 miles per hour. Then when month after month difficulties crop up in getting the commercial plant started, these unexpected expenses cause per-share earnings to dip noticeably. Word spreads that the plant is in trouble. Nobody can guarantee when, if ever, the problems will be solved. The former eager buyers of the stock become discouraged sellers. Down goes the price of the stock. The longer the shakedown lasts, the more market quotations sag. At last comes the good news that the plant is finally running smoothly. A 2-day rally occurs in the price of the stock. However, in the following quarter, when special sales expenses have caused a still further sag in net income, the stock falls to the lowest price in years. Word passes all through the financial community that the management has blundered. At this point, the stock might well prove a sensational buy. Once the extra sales effort has produced enough volume to make the first production scale plant pay, normal sales effort is frequently enough to continue the upward movement of the sales curve for many years. Since the same techniques are used, the placing in operation of a second, third, fourth, and fifth plant can nearly always be done without the delays and special expenses that occurred during the prolonged shakedown period of the first plant. By the time plant number 5 is running at capacity, the company has grown so big and prosperous that the whole cycle can be repeated on another brand new product without the same drain on earnings percentage-wise or the same downward effect on the price of the company's shares. The investor has acquired at the right time an investment which can grow for him for many years. In the original edition, I then used the following words to describe an example of this type of opportunity. I used an example that was still fairly recent at that time. I said, immediately prior to the 1954 congressional elections, certain investment funds took advantage of this type of situation. For several years before this time, American Cyanamid shares had sold in the market at a considerably lower price-earnings ratio than most of the other major chemical companies. I believe this was because the general feeling in the financial community was that, while the Letterly division represented one of the world's most outstanding pharmaceutical organizations, the relatively larger industrial and agricultural chemical activities constituted a hodgepodge of expensive and inefficient plants flung together in the typical stock market merger period of the booming 1920s. These properties were generally considered anything but a desirable investment. Largely unnoticed was the fact that a new management was steadily but without fanfare cutting production costs, eliminating deadwood, and streamlining the organization. What was noticed was that this company was making a huge bet, making a major capital expenditure for a company its size in a giant new organic chemical plant at Fortier, Louisiana. So much complex engineering was designed into this plant that it should have surprised no one when the plant lagged many months behind schedule in reaching the break-even point. As the problems at Fortier continued, however, the situation added to the generally unfavorable light in which American Cyanamid shares were then being regarded. At this stage, in the belief a buying point was at hand, the funds to which I have already referred acquired their holdings at an average price of 45 3/4. This would be 22 7/8 on the present shares as a result of a 2-for-1 stock split which occurred in 1957. What has happened since? Sufficient time has elapsed for the company to begin getting the benefits of some of the management activities that were creating abnormal costs in 1954. Fortier is now profitable. Earnings have increased from $1.48 per present common share in 1954 to $2.10 per share in 1956 and promise to be slightly higher in 1957, a year in which most chemical, though not pharmaceutical, profits have run behind those of the year before. At least as important, Wall Street has come to realize that American Cyanamid's industrial and agricultural chemical activities are worthy of institutional investment. As a result, the price-earnings ratio of these shares has changed noticeably. A 37% increase in earnings that has taken place in somewhat under 3 years has produced a gain in market value of approximately 85%. Since writing these words, the financial community's steady upgrading of the status of American Cyanamid appears to have continued. With earnings for 1959 promising to top the previous all-time peak of $2.42 in 1957, the market price of these shares has steadily advanced. It now is about 60, representing a gain of about 70% in earning power and 163% in market value in the 5 years since the shares referred to in the first edition were acquired. I would like to end the discussion of American Cyanamid on this happy note. However, in the preface to this revised edition, I stated I intended to make this revision an honest record and not the most favorable-sounding record it might appear plausible to present. You may have noticed that in the original edition I referred to this 1954 purchase of Cyanamid stock by certain funds. These funds are no longer retaining the shares, which were sold in the spring of 1959 at an average price of about 49. This was of course significantly below the current market but still represented a profit of about 110%. The size of the profit had nothing whatsoever to do with the decision to sell. There were 2 motives behind this decision. One was that the long-range outlook for another company appeared even better. You will find this discussed in the next chapter as one of the valid reasons for selling. While not enough time has yet passed to give conclusive proof one way or the other, so far comparative market quotations for both stocks appear to have warranted this move. However, there was a second motive behind this switch of investments which hindsight may prove to be less creditable. This was concerned that in relation to the most outstanding of competitive companies, American Cyanamid's chemical, in contrast to its pharmaceutical business, was not making as much progress in broadening profit margins and establishing profitable new lines as had been hoped. Concern over these factors was accentuated by uncertainty over the possible costs of the company's attempt to establish itself in the acrylic fiber business in the highly competitive textile industry. This reasoning may prove to be correct and still could turn out to have been the wrong investment decision because of bright prospects in the Letterly or pharmaceutical division. These prospects have become more apparent since the shares were sold. The possibilities for a further sharp jump in Letterly earning power in the medium-term future center around 1. A new and quite promising antibiotic, and 2, in time a sizable market for an oral, live polio vaccine, a field in which this company has been a leader. These developments make it problematic and a matter that only the future will decide as to whether this decision to dispose of Cyanamid shares may not have been an investment mistake. Because studying possible mistakes can be even more rewarding than reviewing past successes, I am going to suggest, even at the risk of appearing presumptuous, that anyone seriously interested in bettering his investment technique mark these last several paragraphs and reread them after having read the coming chapter on when to sell. Now let me turn to the next and more recent example of this type of purchasing opportunity which I cited in the original edition. I said, a somewhat similar situation may be occurring in the second half of 1957 in the case of the Food Machinery and Chemical Corporation. A few large institutional buyers have liked these shares for some time. Many more, however, seem to feel that in spite of some elements of interest they want evidence concerning certain matters before acquiring shares. To understand this attitude, it is necessary to go into some of the background. Prior to World War II, this company had confined its activities to a diversified line of machinery manufacture. As a result of brilliant management and equally brilliant developmental engineering, Food Machinery had become one of the spectacularly successful investments of the pre-war period. Then during the war, in addition to going into the related line of ordnance manufacture at which the company has been comparably successful, the company built up a diversified chemical business. Reason for this was a desire to stabilize the cyclical tendency of the machinery business through the manufacture of consumable products, sales of which over the years could be continuously expanded through research in much the same manner as had been so successfully exploited in the machinery and ordnance divisions. By 1952, 4 separate companies had been acquired and were converted into 4, now 5, divisions. Combined, they represent slightly less than half the total sales volume if ordnance activities are included, slightly more than half if only the normal non-defense activities are considered. Before and in the early acquisition years, these chemical units varied enormously. One was a leader in a rapidly growing field with broad profit margins and excellent technical prestige in the industry. Another suffered from obsolete plant, low margins, and poor morale. The average of all left much to be desired in comparison with the real leaders among chemical companies. In some cases, there were intermediate products without basic raw materials. In others, there were plenty of low-profit raw materials, but few products with higher profit margins that could be built from these raw materials. The financial community reached some pretty definite conclusions on all this. The machinery divisions, with an internal growth rate of 9 to 10% per annum comparable to the chemical industry as a whole, with a demonstrated ability to design and sell ingenious and commercially worthwhile new products year after year, and with some of the lowest cost plants in their respective fields, represented the highest grade investment. However, until the chemical divisions could demonstrate broader overall profit margins and other evidence of intrinsic quality, there was little desire to invest in this combined enterprise. Meanwhile, the management went aggressively to work to solve this problem. What did they do? Their first move was through internal promotions and external recruitments to build up a top management team. This new team spent money on modernizing old plant, developing new plant, and on research. Entirely aside from plant expenditures that are normally capitalized, it is impossible to undergo major modernization and plant expansion without running up current expenses as well. It is rather surprising that all the abnormal expenses that occurred in 1955, 1956, and 1957 did not cause reported chemical earnings to decline during that period. The fact that earnings held steady gives strong indication of the worth of what had already been done. In any event, if projects have been properly planned, the cumulative effect of those already completed must in time outweigh the abnormal expense of those still to come. Something of this sort might have happened as far back as 1956 if research expenditures in the year had not been increased about 50% above the 1955 levels. This was done even though in 1955 these expenditures for chemical research were not far below the average of the industry, and those for machinery research were well above that of most segments of the machinery business. In spite of continuing this higher level of research, such an earnings spurt was expected in the second half of 1957. At mid-year, the company's modernized chlorine cells at South Charleston, West Virginia, were scheduled to go on stream. Unexpected troubles, characteristic of the chemical industry but from which this company had been surprisingly free in most of its other modernization and expansion programs, indicate that it will be the first quarter of 1958 before this earnings spurt will now occur. I suspect that until this earning betterment comes and chemical profit margins grow and continue to broaden for a period of time, the institutional buyer will generally fail to look beneath the surface and will largely stay away from the stock. If, as I suspect will happen, such a development manifests itself in 1958 and 1959, financial sentiment sometime in that period will come around to recognizing the basic improvement in fundamentals that started several years before. At that time, the stock, which may then continue to grow for years, will be selling at a price that has advanced partly because of the improvement in per-share earnings that had already occurred, but even more because of the changed price-earnings ratio that results from a general reappraisal of the company's intrinsic quality. I believe the record of the past 2 years emphatically validates these comments. Possibly the first general recognition of what had been happening beneath the surface came when, in the depression-like year of 1958, a year when nearly all chemical and machinery companies showed a decided drop in earning power, food machinery reported profits at an all-time peak of $2.39 per share. This was moderately above the levels of the several preceding years when the general economy was at higher levels. It was a tip-off that the chemical divisions were at last being brought to a point where they could take their place along with the machinery end of the business as a highly desirable and not a marginal investment. While 1959 profits are not yet available as these words are written, the sharp gains in earning power reported for the first 9 months over the corresponding period of 1958 give further assurance that the long period of reorganizing the chemical divisions is bearing rich fruit. The 1959 gains are perhaps particularly significant in that this is the year in which the Ordnance Division is in transition from its former principal product of an armored personnel and light equipment amphibious tank-like carrier made of steel, to an aluminum one that can be dropped from the air by parachute. This means that 1959 was the one year in the recent past or foreseeable future in which ordnance activities made no significant contribution to total earning power. Yet an important new earning peak was attained. How's the market responding to all this? At the end of September 1957, when writing of the first edition was concluded, these shares were selling at 25.25. Today they are at 51, a gain of 102%. It is beginning to look as though the financial sentiment I mentioned in the original edition is beginning to recognize the basic improvement in fundamentals that started some years before. Other events are confirming this trend and may give further impetus to it. In 1959, the McGraw-Hill publications inaugurated a new custom. They decided each year to give an award for outstanding management achievement in the chemical industries. To determine the first winner of this honor, they selected an unusually distinguished and informed panel of 10 members. For represented leading university graduate schools of business administration, 3 came from major investment institutions with heavy holdings in the chemical industry, and 3 were leading members of prominent chemical consulting firms. 22 companies were nominated and 14 submitted presentations. This award for management accomplishment did not go to one or another of the giants of the industry, the managements of several of which, with very good reason, are highly respected in Wall Street. Instead, it went to the chemical divisions of the Food Machinery Corporation, which 2 years before had been regarded by most and is still regarded by many institutional stock buyers as a rather undesirable investment. Why is a matter of this sort of major importance to long-range investors? First, it gives strong assurance that, plus or minus the trend of general business activity, the earnings of such a company will grow for years to come. Informed chemical businessmen would not give this kind of award in the industry to a company that did not have the research departments to keep developing worthwhile new products and the chemical engineers to produce them profitably. Secondly, this type of award will leave its impression on the investment community. Nothing is more desirable for stockholders than the influence on share prices of an upward trend of earnings multiplied by a comparable upward trend in the way each dollar of such earnings is valued in the marketplace, as I mentioned in my concluding remarks about this company in the original edition. Other matters besides the introduction of new products and the problems of starting complex plants can also open up buying opportunities in the unusual company. For example, a Middle Western electronic company was, among other things, well known for its unusual and excellent labor relations. It grew to a point where size alone forced some change in its method of handling employees. An unfortunate interplay of personalities caused friction, slowdown strikes, and low productivity in an enterprise heretofore known for its good labor relations and high labor productivity. At just this time, the company made one of the very few mistakes it has made in judging the potential market for a new product. Earnings dropped precipitously, and so did the price of the shares. The unusually able and ingenious management made plans at once to correct this situation. While plans can be made in a matter of weeks, putting them into effect takes much longer. As results from these plans began coming through to earnings, the stock reached what might be called buying point A. However, it took about a year and a half before all the benefits could flow through to the profit statement. Toward the end of this period, a second strike occurred, settlement of which was the last step needed to enable the company to restore competitive efficiency. This strike was not a long one. Nevertheless, while this short and relatively inexpensive strike was occurring, word went through the financial community that labor matters were going from bad to worse. In spite of heavy buying from officers of the company, the stock went lower. It did not stay lower for long. This proved to be another of the right sort of buying opportunities from the standpoint of timing, and might be called buying point B. Those who looked beneath the surface and saw what was really happening were able to buy, at bargain prices, a stock that may well grow for them for many years. Let us see just how profitable it might have been if an investor had bought at either buying point A or buying point B. I do not intend to use the lowest price, which a table of monthly price ranges would show that this stock reached in either period. This is because only a few hundred shares changed hands at the extreme low point. If an investor had bought at the absolute lows, it would have been more a matter of luck than anything else. Instead, I will use a figure moderately above the low in one case and several points above in the other. In each instance, a good many thousand shares were available and changed hands at these levels. I will use only prices at which the shares could easily have been bought by anyone making a realistic study of the situation. At buying point A, the stock had slipped in just a few months by about 24% from its former peak. Within about a year, those who bought here would have had a gain in market value of between 55% and 60%. Then came the strike that produced buying point B. The stock dropped back almost 20%. Strangely enough, it remained there for some weeks after the strike ended. At this time, a brilliant employee of a large investment trust explained to me that he knew how good the situation was and what was almost sure to happen. Nevertheless, he would not recommend the purchase to his financial committee. He said certain of the members were sure to check with Wall Street friends and not only turn down his recommendation but rebuke him for bringing to their attention a company with a sloppy management and hopeless labor relations. As I write this not so many months later, the stock has already risen 50% from buying point B. This means that it is now up over 90% from buying point A. More important, the company's future looks brilliant, with every prospect that it will enjoy abnormal growth for years to come, just as it did for some years before the combination of unusual and temporary unfortunate occurrences produced buying points A and B. Those who bought at either time got into the right sort of company at the right sort of time. In short, the company into which the investor should be buying is the company which is doing things under the guidance of exceptionally able management. A few of these things are bound to fail. Others will from time to time produce unexpected troubles before they succeed. The investor should be thoroughly sure in his own mind that these troubles are temporary rather than permanent. Then, if these troubles have produced a significant decline in the price of the affected stock and give promise of being solved in a matter of months rather than years, he will probably be on pretty safe ground in considering that this is a time when the stock may be bought. All buying points do not arise out of corporate troubles. In industries such as chemical production, where large amounts of capital are required for each dollar of sales, another type of opportunity sometimes occurs. The mathematics of such situations are usually about like this. A new plant or plants will be erected for, say, $10 million. A year or two after these plants are in full-scale operation, the company's engineers will go over them in detail. They will come up with proposals for spending an additional, say, $1.5 million. For this 15% greater total capital investment, the engineers will show how the output of the plants can be increased by perhaps 40% of previous capacity. Obviously, since the plants are already profitable and 40% more output can be made and sold for only 15% more capital cost, and since almost no additional general overhead is involved, the profit margin on this extra 40% of output will be unusually good. If the project is large enough to affect the company's earnings as a whole, buying the company's shares just before this improvement in earning power has been reflected in the market price for these shares can similarly mean a chance to get into the right sort of company at the right time. What is the common denominator of each of the examples just given? It is that a worthwhile improvement in earnings is coming in the right sort of company, but that this particular increase in earnings has not yet produced an upward move in the price of that company's shares. I believe that whenever this situation occurs, the right sort of investment may be considered to be in a buying range. Conversely, when it does not occur, an investor will still in the long run make money if he buys into outstanding companies. However, he had then better have a somewhat greater degree of patience, for it will take him longer to make this money, and percentage-wise it will be a considerably smaller profit on his original investment. Does this mean that if a person has some money to invest, he should completely ignore what the future trend of the business cycle may be and invest 100% of this fund the moment he has found the right stocks, as defined in Chapter 3, and located a good buying point as indicated in this chapter? A depression might strike right after he has made his investment. Since a decline of 40 to 50% from its peak is not at all uncommon for even the best stock in a normal business depression, is not completely ignoring the business cycle rather a risky policy? I think this risk may be taken in stride by the investor who, for a considerable period of time, has already had the bulk of his stocks placed in well-chosen situations. If properly chosen, these should by now have already shown him some fairly substantial capital gains. But now, either because he believes one of his securities should be sold or because some new funds have come his way, such an investor has funds to purchase something new. Unless it is one of those rare years when speculative buying is running riot in the stock market and major economic storm signals are virtually screaming their warnings, as happened in 1928 and 1929. I believe this class of investor should ignore any guesses on the coming trend of general business or the stock market. Instead, he should invest the appropriate funds as soon as the suitable buying opportunity arises. In contrast to guessing which way general business or the stock market may go, he should be able to judge with only a small probability of error what the company into which he wants to buy is going to do in relation to business in general. Therefore, he starts off with two advantages. He is making his bet upon something which he knows to be the case, rather than upon something about which he is largely guessing. Furthermore, since by definition he is only buying into a situation which for one reason or another is about to have a worthwhile increase in its earning power in the near or medium-term future, he has a second element of support. Just as his stock would have risen more than the average stock when this new source of earning power became recognized in the marketplace if business had remained good, so if by bad fortune he has made his new purchase just prior to a general market break, the same new source of earnings should prevent these shares from declining quite as much as other stocks of the same general type. However, many investors are not in the happy position of having a backlog of well-chosen investments bought comfortably below present prices. Perhaps this may be the first time they have funds to invest. Perhaps they may have a portfolio of bonds or relatively static non-growth stocks which at long last they desire to convert into shares that in the future will show them more worthwhile gains. If such investors get possession of new funds or develop a desire to convert to growth stocks after a prolonged period of prosperity and many years of rising stock prices, should they, too, ignore the hazards of a possible business depression? Such an investor would not be in a very happy position if later on he realized he had committed all or most of his assets near the top of a long rise or just prior to a major decline. This does create a problem. However, the solution to this problem is not especially difficult, as in so many other things connected with the stock market it just requires an extra bit of patience. I believe investors in this group should start buying the appropriate type of common stocks just as soon as they feel sure they have located one or more of them. However, having made a start in this type of purchasing, they should stagger the timing of further buying. They should plan to allow several years before the final part of their available funds will have become invested. By so doing, if the market has a severe decline somewhere in this period, they will still have purchasing power available to take advantage of such a decline. If no decline occurs and they have properly selected their earlier purchases, they should have at least a few substantial gains on such holdings. This would provide a cushion so that if a severe decline happened to occur at the worst possible time for them, which would be just after the final part of their funds had become fully invested, the gains on the earlier purchases should largely, if not entirely, offset the declines on the more recent ones. No severe loss of original capital would therefore be involved. There is an equally important reason why investors who have not already obtained a record of satisfactory investments and who have enough funds to be able to stagger their purchases should do so. This is that such investors will have had a practical demonstration prior to using up all their funds that they or their advisors are sufficient masters of investment technique to operate with reasonable efficiency. In the event that such a record had not been attained, at least all of an investor's assets would not be committed before he had had a warning signal to revise his investment technique or to get someone else to handle such matters for him. All types of common stock investors might well keep one basic thought in mind. Otherwise, the financial community's constant worry about and preoccupation with the danger of downswings in the business cycle will paralyze much worthwhile investment action. This thought is that here in the mid-20th century, the current phase of the business cycle is but one of at least 5 powerful forces. All of these forces, either by influencing mass psychology or by direct economic operation, can have an extremely powerful influence on the general level of stock prices. The other 4 influences are the trend of interest rates, the overall governmental attitude toward investment and private enterprise, the long-range trend to more and more inflation, and, possibly most powerful of all, new inventions and techniques as they affect old industries. These forces are seldom all pulling stock prices in the same direction at the same time. Nor is any one of them necessarily going to be of vastly greater importance than any other for long periods of time. So complex and diverse are these influences that the safest course to follow will be the one that at first glance appears to be the most risky. This is to take investment action when matters you know about a specific company appear to warrant such action. Be undeterred by fears or hopes based on conjectures or conclusions based on surmises.